Just to go into it again, I'm going to go top down. So for those of you that have not met me, I'm Andrew Notohamiprodjo. I currently am the head of data science at Delos Insurance Solutions, which is a partner of SIG. Today, I'm here to share with you insights into the home insurance market, especially in the context of the increasing risks and challenges posed by wildfires in California. So home insurance is a crucial safeguard for homeowners, offering protection against a variety of risks and unforeseen incidents. In recent years, we've seen how devastating wildfires can be, not only to the landscapes and communities, but also to the stability and dynamics of the home insurance market. So in this presentation, we'll start by understanding the basics of home insurance, what it is and why it's essential, and then we'll dive into the roles and differences between managing general agents, MGAs, which are companies like Delos, and admitted insurance carriers, which are companies like State Farm and whatnot. And these are the reason we're going to go into that, because these are two key players in the market, and understanding the difference kind of tells you how the problem is being approached nowadays. One of the most complex aspects of the industry is pricing. We're going to explore how insurance is priced both for MGAs and admitted carriers, and how reinsurance factors into this. So catastrophic events like wildfires significantly impact pricing models, and we're going to discuss this using concepts like the idea of annual average loss, AAL, and aggregate exceedance probability, AEP. The recent wildfire disasters have left a profound impact on the home insurance market, so we're going to examine the effects and the challenges that have arisen as a result, particularly in the context of claims processing and the capacity of homeowners to rebuild in the wake of mega disasters, as kind of a way to round out the discussion. And then we'll conclude looking at the vital role of research in shaping the future of home insurance, particularly in areas prone to wildfires. That's you guys. How can we as an industry collaborate with research communities to better understand and mitigate these risks? So before we go into the details of home insurance market, let me tell you a little bit more about myself so you can see the context I'm presenting this information from. My journey to this role as the head of data science has been an interesting one. I started my career as an environmental science major at UC Santa Barbara, but found myself spending about 10 years teaching high school when I couldn't find an environmental science job during the recession. Woohoo. After a wonderful time in the classroom, I switched back to the sciences by pursuing a master's in environmental management at USF, where I met David Sa and Fernanda in the GSAL. And then everything fell into place after that. My interests at the time were in applying machine learning solutions to spatial problems, which naturally led to David throwing me into the Delos project. Initially, once I graduated, I worked with Delos as a SIG employee, working only on their model. At the same time I was working on the Delos model, I was over at UC Merced, helping contribute to the Pyrogen's forecast through the forecasting models through Work Group 4. Eventually, I stopped my work with Work Group 4 because Delos saw the need to have me work for them full-time to interface with investors, business partners, and work on pretty much all the burgeoning data needs a startup has. And as a result, I grew into the role of the head of data science. So what do I do? So in this position, I oversee all aspects of data science in the company, from business intelligence and database management to machine learning and artificial intelligence applications. My primary domain is still all the things wildfire in the company, but I work on pretty much everything at the company that's related to insurance and data. One of the best parts of working at Delos is that I get to continue to work with SIG. Delos was born out of the intersection of the cutting edge research that David, Max, and Gary were doing at SIG, and the entrepreneurial vision of Kevin and Shanna, the co-founders of Delos, who saw an opportunity to apply this research to the home insurance industry. The partnership works out because SIG owns a large share of Delos, and in return provides Delos with data and expertise to support our wildfire modeling capabilities, which allows us to be one of the premier insurance carriers in the market writing for these wildfire exposed homes. So in comparison, most companies, instead of having this partnership with a research company, they rely on third-party data sources or catastrophe modelers, and those have limitations or uncertainties in their methods and outputs. So again, this partnership with SIG is really what drives home our success in the business right now. And I can't stress enough how important you guys are to the research and the development of everything we do here. Again, one more time to recap just this introduction slide. The goal of this Lunch and Learn session is to deepen the relationship between SIG and Delos. It was kind of fun to see the mysterious looks. You guys are like, oh, we have a home insurance company at the retreat. So I want to kind of continue to build that relationship. to share with you how your data is making an impact outside of the pure research and space. And I also want to help you understand what exactly is home insurance, why it's relevant and important for you guys, even though it might be pretty far removed. Because home insurance is not just a financial construct, it's also a social and environmental one as well, because it affects how people perceive and respond to risks, how they recover and rebuild after disasters, and how they adapt and prepare for the future. So as researchers, you guys have a vital role to play in the shaping of the home insurance market, particularly in areas prone to wildfires and other disasters. So I hope this session will inspire you to continue to think of how to take all the great things that you make and deliver them in even more meaningful ways. So insurance is just a very direct example of one application, but there are many opportunities out there. So I look forward to exploring these with you as we continue through the discussion. But first, let's go on our journey through what insurance is and understand the challenges and opportunities that lie ahead for this market in wildfire exposed areas. So again, sorry if it sounds more like a lecture. I'm nervous, if you can't tell. Let's begin by demystifying what we mean when we talk about home insurance. At its core, home insurance is a form of property insurance that covers losses and damages to an individual's house and the assets within it. So it serves as a financial shield against various forms of damage, whether it's from natural disasters, theft, or accidents in the home. There's three main elements of coverage in a typical home insurance policy. The first one is the dwelling. This is perhaps what most people first think of. It covers the physical structure of your home. So if your house suffers damage due to events like fires, storms, or other covered incidents, the dwelling coverage helps pay for the repairs or the rebuilding. The second thing that it covers is personal property. So this aspect of the policy covers the contents of your home. So think of your furniture, electronics, clothing, other personal items. If these are lost, damaged, or stolen, personal property coverage can help reimburse you for these losses. And lastly, coverage normally also protects liability. So what is often overlooked but equally important, liability coverage protects you if someone in your is injured on your property, or if you or your family members cause damage to others' properties. It can cover legal fees and any damages you're found responsible for. And that's a fun one people kind of forget about. So the primary purpose of home insurance is to provide financial protection against unforeseen and adverse events. It's not just about protecting the structure of your home, but also safeguarding your financial well-being in the face of potential disasters or liabilities. And understanding this foundation will help us as we dive deeper into how the insurance market operates, especially in high-risk areas like those prone to wildfire. So going on, let's talk about the two fundamental entities in the insurance world: managing general agents or agencies called MGAs and admitted insurance carriers. This distinction is crucial in understanding the dynamics of the insurance market, especially in specialized risk areas like those affected by wildfires. So MGAs, or again, managing general agencies like Delos, are somewhat like brokers, with significant underwriting authority from insurers. So what we do is we focus on specialized or niche markets that require a deeper understanding of specific risks. MGAs like us have the flexibility to tailor policies more closely to individual needs, which is particularly valuable in areas with unique risks such as wildfire zones. And we'll go into more detail on that as we go through the presentation. In contrast, admitted insurance carriers like State Farm or Geico are state licensed and they're subject to state regulations and protections. They tend to offer more standardized insurance products, but one advantage of the admitted carrier, actually the key advantage of the admitted carrier, is that in the event the carrier fails, like what happened with the Camp Fire and other mega fires like that, there's a safety net for policyholders through state guarantee funds. So again, if the insurance company runs out of money, but it is an admitted carrier, the state actually guarantees the reimbursement of your insurance policy, versus an MGA doesn't necessarily do that, and you have to be careful. So to break it down further, just going through this kind of table I have to help kind of understand the definitions. When we consider the regulatory oversights, MGAs operate through partnerships with admitted carriers and are subject to less direct state regulation. Admitted carriers, meanwhile, are heavily regulated at the state level, ensuring that a high standard of practice and financial stability is offered. When it comes to the risk approach, MGAs have more leeway in underwriting, allowing us to cover risk that admitted carriers might avoid. Admitted carriers, given their regulatory framework, often have stricter underwriting guidelines, such as the rules in California, where admitted carriers can't use forward predicting models like climate scenarios in pricing. So this is really kind of frustrating for them, especially with wildfire. They're actually not allowed to use a predicted risk layer inside their inside their pricing. So in order to price for a wildfire, they only can use historical losses, which is kind of a fun fact. They get around this in a lot of different ways, but that's a complication we're not going to go into right now. As a result, the typical coverage differs between the two. MGAs can offer unique and customized policies, which is particularly beneficial in markets like California's wildfire-prone areas. But admitted carriers provide more generalized policies that might not cater as closely to such specific needs. Um, and this kind of difference in coverage gives us market flexibility. MGAs can quickly adapt to the changing market needs due to their less restricted regulatory environment, versus admitted carriers, while they're more stable, might not be as nimble in response to market shifts, especially in a state like California where the rate changes must be public and are capped and approved by the Department of Insurance. Versus as an MGA, if something happens, I can immediately close a market, I can open a market, I can change the pricing based on the needs of the consumers and the needs of the disasters. So understanding the differences between the MGAs and admitted carriers is crucial, especially when we discuss about how insurance is priced and how we continue to talk about how both of these different companies respond to catastrophic events. Again, there's a lot of information here, so please feel free to stop me or ask questions in the chat or anything if you have any questions that come as a result. So as we get more into the world of insurance, one of the most pivotal aspects is how policies are priced. For those of you that are homeowners or even people that rent homes, you understand the frustration of this, that it can be very dynamic and differ based on all of these really random things sometimes. So whether from an MGA or an admitted carrier, the pricing strategy hinges on several core principles. Now, and it's pretty much three things: the risk assessment, the historical data analysis, and the actuarial science. So the risk assessment, this is pretty much the likelihood of an event occurring and the potential impact it could have. So for example, in areas prone to wildfires, the risk assessment would consider factors like location, historical fire incidents, and environmental conditions. So this is also for things like flood, burglary, water damage, actual like dwelling fire, which is like if the fire starts inside the house. There are risk layers that show the chance that an event actually occurs. Now, the second part, there's historical data. This is where insurers look at past data to predict future claims, and this is more of the vulnerability stuff. So what they're doing is they're looking at how likely is a particular building and characteristics of the building going to be at risk of an event because of past history of similar things. So what we do is we analyze the trends and patterns of these, and then we predict the probability and severity of the vulnerability. So it's really important to know the risk is an event and the historical data set is a vulnerability that is more in line with the actual structure. And now the final thing is the actuarial science. It's the backbone of the insurance pricing. Actuaries use the statistical methods. Methods to combine the risk assessment and the historical data to set premiums that are both competitive and sufficient to cover potential claims. And again, what defines competitive and sufficient really changes based on the company and the domain space that they're operating in. Which is why you can see the price fluctuate very, very drastically between different carriers and, again, different coverages that you're looking for. So now let's compare, again, going through this table, the pricing strategies of an MGA versus an admitted carrier, because then you can see how Delos exists and operates. So MGAs with our specialized focus are less direct with regulatory oversight, which means we have a lot of flexibility in setting the prices. We can quickly adapt to the changing market conditions or risk profiles versus, again, like I said earlier, admitted carriers are more regulated and they are significantly limited in how much they can change their prices. Both MGAs and admitted carriers increasingly rely on advanced analytics and big data to refine their pricing strategies. But MGAs actually have a lot more leeway in leveraging innovative methods and data sources to assess unique and emerging risks like wildfire. Again, admitted carriers can't use for predicting models in California. So and as a result, their limitations make them slower by nature. They're generally inflexible because they also need to balance any financial changes across a larger portfolio. Again, like a carrier like us at Delos is only interested in the wildfire space versus an admitted carrier like State Farm is going to be writing for both for wildfire, flood, and for all the regular perils like burglary and things like that. They need to balance that. And again, looking at the one, just to recap, admitted carriers are subject to state-specific regulatory constraints that affect their pricing models. They need to justify every time they want to change their rates and adhere to established guidelines. Versus MGAs, we're not bound by the same thing. We're actually only limited by the insurance partner. So again, MGAs have to have an insurance partner in order to exist. So that's the only actual limitation we have on setting our price. Going on, this is getting a little bit more into the nitty-gritty, but this is actually really important in order to understand what's influencing the problems with places like California. And this is to frame the context of disaster insurance. So a major but often overlooked and unseen component of the insurance pricing is reinsurance. So in simple terms, reinsurance is insurance for insurance companies. It plays a crucial role in the overall stability and pricing of insurance policies, especially in the context of high-risk areas like wildfire zones. So what exactly does reinsurance do? It allows primary insurers like MGAs and admitted carriers to mitigate the risk exposure. This works because they transfer portions of their risk to the reinsurers. This works because we transfer a portion of the risk to the reinsurers, and what it does, it allows us to protect against the financial impact against a large-scale claims, such as something that happened for wildfire. So, for example, an insurance company might only hold $50 million in the bank to cover claims, and then they have a $100 million disaster. This allows them to transfer that excess over to the reinsurance so that they can still fulfill the needs of their customers. So again, just want to point out the ways that reinsurance helps the market. So reinsurance stabilizes the insurance market because it spreads out the risk to national and international portfolios. They make sure that a single catastrophic event doesn't lead to the financial collapse of an industry as a whole. So for example, if California is all on fire, hopefully South America is not on fire at the same time. And a reinsurance company would have an international portfolio rather than a domestic portfolio. So the risk would be spread out across that entire financial portfolio. And then I think I just covered that again. Reinsurance spreads the risk of large claims. So this is important in the context of natural disasters. Like I said, by sharing the risk with reinsurers, insurance companies can offer coverage for high risk scenarios that they might otherwise not be able to. So now how does this impact pricing? Going back to that discussion, reinsurance plays a significant role in maintaining financial stability for insurance companies, which in turn influences their ability to set competitive premiums. So for instance, without reinsurance, the cost of covering high-risk areas like wildfire-prone regions could become prohibitively expensive, and it already is, leading to higher premiums for policyholders or the withdrawal of insurance providers from the market altogether, which, again, it already has. And we're going to find out why. This chart that I included here is this really interesting relationship between all the different parts of the industry. So you have the policyholders, which are people like you and I that work with our insurers that insure us on a local or regional basis. We pay them premium, they give us coverage. Insurers also do the same for their reinsurers. They're local, regional, and then they purchase coverage through national and international reinsurers, and then reinsurers get their money actually from capital markets through cat bonds and securities. And there's these really interesting adjacent relationships between rating agencies and insurance commissioners, which is pretty much the government in this case. The rating agency we'll talk about a little bit. They kind of are like the credit agency of insurance, and there is credit scores that affect the ability for an insurance company to get money and to get rate changes that is determined by these rating agencies. And the insurance commissioners, the governments set the regulations. But in the case of reinsurers and insurance companies, they also pay a premium to the government when they're admitted carriers, so that the government, again, can cover in the case of a true disaster. The government will step in and help pay the claims if need be. And that's where that relationship is. And we'll kind of touch on this again in a second. Okay, so now we're going to go to the actual breakdown of the pricing, and it kind of shows how this pricing model has actually driven insurance companies out of California and other parts of the United States. So an insurance premium is typically divided into several components. The largest portion that you see here is between 40 and 60% goes to claims expenses. Sorry. Um, and that's a figure that's actually a lot higher in places like California. We're seeing that the claims expense, uh, in the case of a disaster, the claim expense by premium actually exceeds the 100%. So, for example, the reason why this works is because your premium per year might be $100, but your house is worth 100,000. So if your home burns down, their expense is $100,000 where you've only paid $100. So that's why you can exceed 100% of that. But typically, your premium goes to 40 to 60% goes to paying for the claims expenses of the company as a whole, because again, they diversify over a large portfolio. Um, Operating expenses, including salary and marketing, account for about 15 to 25%. So if you're worried about price gouging and things like that, this is where you would normally complain about it. Reinsurance costs typically range from 5 to 15%. But in California, these can be a lot higher, again, just because of the most recent disasters. In Florida, these are a lot higher also because of hurricanes and things like that. Um, Now, the profit margin for insurance companies varies, but it's generally kept competitive and actually very small, around 2 to 10%. Just a fun fact, as an MGA, your profit comes from this part. So the insurance company will take their they have the 2 to 10%, and the MGA gets maybe a quarter or less depending on your partnership of it. So for every $100 that we sell, the insurance company only makes maybe $1 if it's an MGA, or up to $10 if it's a regular insurance company. So the financials are actually very small, even though they have a lot of money. Taxes and regulatory fees make another 2 to 5% covering compliance costs. That goes to the federal government and state and federal governments. Risk assessments like home inspections and underwriting usually accounts for 1 to 5% of the premium. And insurers set aside another 10 to 20% for future claims. Again, this goes to their claims pool, but again, that reserve is higher in high risk areas. Now, we're going to focus on the California specific scenario, and that's what these boxes here are on the left, just to kind of frame the conversation. So California is unique because of Prop 103. That's the state's regulation that prevents insurance companies from passing on reinsurance costs directly to the consumers and limits the insurance rate increases. Originally, this was passed to protect consumers from broader market influences and price gouging, which is a good thing. However, what this has actually done is caused unrest in the admitted market. The rate increase caps barely cover the increases needed to reflect inflation. So, with the recent spike in wildfire incidents and the extreme losses incurred, reinsurance costs have become significantly higher. Now, instead of being like 5 to 15%, they kind of can be up to 40 to 50% of the premium in some cases. This wouldn't be a big deal if insurers could just pass it on to the consumer, so the rate increase wouldn't affect them and they would still be motivated to write insurance. But with Prop 103, they can't, and they can only rely on their price changes. So the increase they would need to, cover that 40 to 50% now in reinsurance costs would far exceed what regulated rate hikes would allow. So that made pretty much every admitted carrier in the state leave in protest because they want a significant increase in premium rates to offset the cost. So if you want to get an idea of how big a rate increase they're looking for, the California Fair Plan, which is the state-sponsored home insurance for people that can't get insurance, they themselves, this is the state, wanted a 48.8% rate increase, which is massive. Fortunately, or unfortunately for them, they only got a 15.7% rate increase, and that was approved for to take effect in 2024. And you can imagine what the admitted market wants if the state-sponsored insurance wanted at 48.8%. So for MGAs writing insurance in wildfire-exposed homes, this situation poses a significant challenge because the uncertainty in the market has made insurance partners hesitant to take on MGA risks without new reinsurance partnerships. So for us, in a normal world, Delos would rely on the insurance partner to pay the claim. So if I was partnered with State Farm, they would have to pay a claim for us. Versus the only way that we can go to business, and actually one of the reasons Delos is so successful is because we partner directly with reinsurance to approach insurance. So we actually offer that our claims will be covered by our reinsurance partner, and we just need the insurance company to write the piece of paper for us. So it's a very unique partnership, and what allows us to be very successful. One last thing, I'm going to try to speed it up to save time for questions. I think we have budget until 11:45. So if I talk a little bit faster, I apologize. All of this stuff, I think I'm going to give this to Megan, and you can see all the talking points if you miss. Um, but going into this next slide, this builds on our discussion by examining how catastrophic events are incorporated into insurance pricing. So this is particularly important because it shows how Delos' model and its modeling capabilities, thanks to SIG, allows us to secure partnerships in the industry while other companies are struggling. So if any of you guys are math oriented, this is actually kind of interesting for you guys. So there are two tools that insurance and reinsurance companies use when they consider how to price risk portion of premium: the average annual loss and the aggregate exceedance probability. So the average annual loss, the AAL, is essentially the estimated yearly cost that an insurer expects to pay out due to catastrophic events. It's a long-term average, taking into account the frequency and severity of past events to predict future losses. So, for example, in areas prone to wildfire, actuaries calculate AAL by analyzing historical fire data, property values, and the current state of risk mitigation measures. Um, Aggregation exceedance probability, AEP, on the other hand, is a bit more complex. It refers to the probability that total losses will exceed a certain amount in a given year. So this metric is crucial for understanding the potential for extreme events and their financial impact. So AEP is used to assess the likelihood of experiencing losses that are significantly higher than the average, helping insurers prepare for worst case scenarios. And you're more familiar with this. Flood is very familiar with this because you have the 1 in 10 year event, 1 in 100 year, 1 in 1,000 year. That's actually the AEP that they're talking about. And a little fun fact about the relationship between the AAL and the AEP: the way you calculate the average annual loss is you just take your AEP curve and you just average every point that you have. It's actually really simple. Um, so in the context of insurance pricing, these two metrics are instrumental. AAL gives insurers a baseline for expected annual losses, which directly influences premium calculations. A higher AAL in a region means higher potential losses, leading to higher premiums. AEP, on the other hand, informs insurers about the risk of rare but catastrophic events. It's particularly relevant for reinsurance as it helps determine the level of coverage needed to protect against outsized losses. What's really interesting is there's a lot of these metrics are standardized by the rating agencies that we kind of referred to in that diagram earlier. And what happened recently is that the event set for fires is really terrible, and with the amount of losses that they've seen, they kind of stopped trusting it. So we at Delos actually created our own event set and published our own AEP and AAL methodology, and we demoed it to a company called AM Best, which is one of those scary rating agencies that was on that diagram, and they actually approved of the use of our model because it better captured the actual risk going forward. Again, that was we made some really interesting modifications to the event set, the vulnerability set, which allowed us to do that. That I am always more than happy to talk about with you. So to put all the previous information into context, the recent wildfire disasters have had a profound impact on the insurance landscape, particularly in California. So first, the increased premiums. As the risk of wildfires have escalated, so too have the associated costs for insurers. This increase in risk is directly reflected in the home insurance premium. So for homeowners in high-risk areas, this often translates to a substantial rise in the cost of insuring their homes. And while this jump in premium might not be apparent from the normal trend, which is capped, which you see here, the 2016, 2017, these black bars. The way we see the true rise in premium costs is by looking at how many policies are actually non-renewed. So due to the heightened risk and resultant financial and political strain, most insurers have chosen to withdraw from the most affected areas. I want to take this moment to go on a little tangent to talk about one other factor other than financial that influences the admitted market's decision to leave California. So if we went back 3 slides and I talked about that box on the left, those rating agencies, on top of incurring massive losses due to claims in the event of a disaster, an insurance company also decreases in rating as a financial institution when they lose things. So this affects their ability to get reinsurance. And in the case of reinsurance, this affects their ability to secure bonds and securities, sort of like how your credit score determines if you can apply for a credit card or a mortgage, but more on I want to buy an island kind of scale rather than I want to buy an iPhone. So it's for this reason as well that insurance companies are incentivized to divest high-risk portions of the portfolio in the wake of severe disaster, which is good for us. They divest it by giving it to companies like us, MGAs. And in the case of California leaving the state altogether, as they would leave the state altogether to remove these off their portfolios so that they don't see these losses in credit rating and finances. They'd rather pay to the state rather than pay your claim. And this leaves insurers, homeowners with fewer options for insurance. And in some cases, it might be challenging to secure insurance at all. I'm sure all of you guys in the Sierra Nevadas are very familiar with this problem. This combination of increased premiums and non-renewals have resulted in a constrained market where homeowners in wildfire-prone areas often led with very limited choices, people having to resort to the FAIR plan, which can be more expensive and offer less comprehensive coverage. So you can see it here in this bottom chart, kind of the reflection that I was talking about, where people are being non-renewed. You can see the spike in FAIR plan as a percentage of total policies in the counties that are actually wildfire exposed, where you're seeing 10%. You're actually, what's kind of sad in 2022 and now 2023 with the non-renewals, you're actually seeing 50 to 60% places of the percentage of the homes that are in high-risk areas that are actually on the FAIR plan. So it's a massive problem, and this graph doesn't do it justice because there's not more recent data published by the Department of Insurance. This slide goes to talking into claims. I'm gonna gloss through this so we can save a little bit more time for questions. But the thing I wanted to illustrate here is that mega disasters make claims processing really challenging. If anyone's ever tried to submit a claim to insurance, you already know it's very challenging by itself. But what happens is that in an event of a mega disaster, the standard claims payouts don't have enough money. So you can see from this diagram, the y-axis is the losses in millions. The x-axis is that AEP curve, but you want to pay more attention to the y-axis. You can see that when it's small, you guys pay, your deductible. That's what this lower part is. After you pay your deductible, the insurer gets triggered, depending on, again, their portfolio. They might cover pretty much all of it or some of it. And then once the disaster gets big enough, the reinsurer gets triggered. Now, what happened with the Camp Fire is that the insurers and the reinsurers could not cover the disaster, so they actually had to go to capital markets and start, going through the whole thing with securities and bonds to actually get the money to pay these people out. And actually, sometimes that's not even enough money where the policyholder, you just have to eat the rest of the loss. And that's happening a lot more often, which is kind of sad. So I'm just going to gloss through this, but again, my notes are on the presentation if you're ever curious. Because what I want to do is I want to talk about SIG, and I want to leave room for you guys to ask questions or make comments. So what we did today is we looked at the complexities of home insurance. I'm sure a lot of you are falling asleep because it's so complicated and just ridiculous. But I want to talk more about you guys at SIG and how I feel like you guys can help in the plight of the insured and the insurance market as a whole. And I broke it down into three main ideas that I got from the retreat together. The idea is that SIG can help predict, help prevent, and help protect. So with the predict, your expertise in the subject domain, spatial modeling and technology is pivotal. Trust me, I've seen every other model in the market. They're terrible. They're not made by people in research. They're made by people in risk that don't actually understand the domain. So by refining predictive models for wildfire, you're not only advancing scientific understanding, but you're empowering homeowners and insurers to better anticipate and mitigate risks. So your work in developing these models helps in creating a more informed and prepared society where individuals understand the steps they need to take to protect their homes and communities. And that leads us to prevent, where the initiatives that your initiatives extend beyond predictions. So by advocating for and implementing scalable solutions like PyUrgent's Plandscape and Collect Earth Online, just to name a few, especially in at-risk and marginalized communities, SIG plays a really crucial role in proactive prevention. So your research and grant initiatives are instrumental in developing strategies that enhance safety and resilience in these vulnerable areas, ensuring that the most at-risk populations are not left behind. And finally, I want to talk about protect. Your engagement with local and national agencies is vital in shaping effective wildfire suppression strategies and public policies. So this collaborative effort is essential not in just protecting the people from the immediate threats of natural disasters, but also in shielding them from the subsequent socioeconomic turmoil. So your insights and research inform policies that balance safety, economic stability, as well as community well-being. So kind of in summary, the work that SIG is doing is really integral, not just in predicting and preventing wildfires, but in creating a holistic approach that protects both the environment and the socioeconomic fabric of our communities. And I'm thankful that I've got to work for both SIG and Delos to deliver these ideas through the home insurance industry. And I'm excited to see where we can go next. And that's pretty much it for our presentation. We've gone through a lot of stuff. the insurance market is extremely complex and has a lot of dynamics that, I hope that I've shed some light into, or at least soothe some of you guys into your lunchtime nap into. I just really wanted to say that I appreciate SIG, and I hope you guys can appreciate the SIG-Delos relationship, because it's the unique contributions of SIG that allowed Delos to be successful and are actually making a lot of changes on the private side of the industry instead of just the academic side. So at this point, I think I saved maybe 4 minutes left in the presentation. Thanks, guys. I love the applause. Again, sorry for talking so fast. It's my first time talking about the insurance industry as a whole. I normally just do the wildfire stuff, but it was kind of fun to be all together and share a little bit about my domain with you all. So are there any questions or any comments before we all go off and go back to the daily work again? Question. I see David. Can you describe at a high level what specifically do you do at Delos? What languages do you use? ML. I particularly code in Python. What ML libraries and how do I apply ML? So what data do I analyze? It's a nightmare, David. It's a nightmare. It's literally everything you can imagine. We do so on the wildfire side. I'm pretty much duplicating a lot of the research that you guys are doing, using TensorFlow, using scikit-learn, Google Earth Engine, all these other tools to create classifications of burn and things like that. After that, I'm doing more of a standard. Using a lot of decision trees and a couple applications of neural networks in doing forecasting for pricing. And then we are also looking at really interesting metrics of like sales pipelines. So like, because the nature of our business is very dynamic, a standard insurance product is bought and sold instantaneously, but a MGA product can take anywhere from instantaneous to months to sell a policy, especially if you're on the FAIR plan. So let's say you're on the FAIR plan in June. You want to know that something exists once you're off that policy because you don't want to take the trouble. So you'll quote with us in December, and I have to figure out, are you serious by the time you get back to next June? So like I'm doing a lot of people analytics, sales analytics. So I'm using primarily Python to do my analyses and all the ML libraries. I have a tool that basically submits my data to, I think I have like 50 different models in there. And I just do analysis on like the top 10 to see like how they're functioning and deploy them if that's the ones that work the most. So
can you talk a little bit just so that these folks know when others ask how the First Street data is being used?
Yeah, so how the First Street data is being used. The First Street data is a wonderful data set that you guys have made. Love the partnership there. It is one of the layers. There's a couple pieces of the First Street data that are used to kind of supplement the data that we use. So we're not just relying on the First Street Foundation to make the Delos risk. We're using it as kind of either a QA/QC layer or, again, one of the inputs in a stack. So, for example, you have conus-wide vegetation. We're combining that with other conus-wide layers, and then we're doing our own internal R&D to kind of see how that interacts with our understanding of the hazard, risk, and vulnerability. Same thing, the actual risk product, First Street Foundation, we don't actually use. We use it as kind of again, a QA/QC to make sure we're not too far off the beaten track because our endpoint is different. We're looking at the actual home loss and the incentives to not lose homes rather than the actual risk of a property by itself. So the First Street Foundation is really crucial because it gives us another really high quality data set for us to utilize in the pipeline. But we're not just reliant on the First Street Foundation stuff. There's a lot of nuance that we have to. That is really interesting. So, for example, I know, David, I've seen your comments in like Mattermost where you're like really frustrated about predicting reality versus like predicting reasonability and things like that. And we're very firmly on the reasonability side. I'm sorry, I think my microphone. Can you guys hear me? Okay. Yeah, we're very firmly on the reasonability side, which is a fascinating space to be because it's not you can't publish papers in that space, but you can make some really great financial decisions. And that's why we don't use the First Street Foundation data directly. So, but I love the data, by the way. It's really, really good. It's really, really good stuff for, to expand the understanding, and it provides, insights into the world that other data sets just don't do. So again, thank you, Gary, for working on that. Megan, I think that's it for me.
All right. Thank you so much, Andrew. And thank you for everybody for attending. Have a great weekend.